Welcome to Module 1A, if you want to call it that, which is the second part of Module 1. In this module, we're going to be taking a look at assets and liability, and then we're going to conclude with a little bit about the auditing process. What's an asset? An asset is something that has value. And the reason why we want to look at assets are that there are a variety of different assets. You might own land, for example. You might have inventory. Your personnel might be assets. You might have a business strategy that might be an asset. You might have a secret recipe such as Coca-Cola or Kentucky Fried Chicken, which those are significantly valuable assets that you want to protect. So when we start taking a look at finance, you have to know your organization. And the first part of that we'd like to take a look at is what are the assets? What do you actually own? And when we look at assets, there are liquid assets and long-term assets. Liquid assets are what can you turn into cash in a short time period, normally within 1 year or less. What are some examples? Cash. If you have cash, you can spend that on anything you want. If you own stock, you can sell stock on the open market tomorrow. You might make a profit, you might lose some, but at least you could turn it into cash. One that is on the border is inventory. If it's some inventory that's valuable and maybe you could sell it quickly, great. If you have partially manufactured goods that have very little value until they're finished, then if you have to sell that, then it really isn't considered a liquid asset because it might be almost impossible to sell it. When we start taking a look at long-term assets, that's probably going to be a stadium, an arena, a practice facility, an office building, oftentimes something that's attached to the ground, whether it's permanently attached to the ground or whether it's something like a big piece of machinery that is going to be depreciated over 5 years, as an example, using accounting methods. So those are important to do, and one of the things we're looking at in this module is to identify all the different assets. A lot of times people don't realize all the assets that might be present. Your personnel might be an asset. You might not think of them as such, you might think of it as a human resource, but if you have a phenomenally well-known person, let's say a well-known sports person, let's say Michael Jordan for Nike, that's a phenomenal asset for them. So you have to go through and take a look at things, and even in some of the weirdest areas, you might take a look and say, I didn't realize that was an asset. For example, a lot of stadiums, when they're being torn apart, they sell used bricks, dirt, grass, whatever it might be, all represent potential assets that can be sold. Because if you could sell it for, let's say, $4 or $5 a brick, well, let's say you have 10,000 bricks. Well, that's a lot of money that you just are able to get now from something in the past that you would have had to pay someone to haul the bricks away. So that's assets. Liabilities are your obligations. And obligations can be liquid obligations, what you owe and need to be paid immediately, versus long-term liabilities. So if we start taking a look at these liquid liabilities, the short-term liabilities that are seen on financial statements, on balance sheets, and we start taking a look at what might be out there, you might have, for example, electrical bills, gas bills, phone bills. You might have payroll on there, so what you pay employees versus what you pay contractors. Those are things that are due immediately. And you might pay them in 60 days, you might pay them in 30 days, you might pay them in 90 days. Whatever it is, they represent your obligations. Long-term liabilities are primarily going to be, if you're going to be buying, for example, a team, building a stadium, building a new factory, building a new health club, whatever it might be, you spend a lot of money and you're borrowing money in order to finance it. So short term, that's basically, for example, like your credit card, you're borrowing money with the obligation that at the end of 30 days you have to repay that money, and if you don't repay it within 30 days, you're charged interest at a very significant rate. Long-term liabilities, you understand that, yes, I'm going to be borrowing money, hopefully at a lower interest rate, but I'm going to be paying this off over maybe 20, 30 years. And so that gives you some kind of freedom and flexibility to know that you can spend money that you owe for current liabilities on those current liabilities and then pay off gradually the long-term debt. As we will find out when we look at balance sheets, assets equal liability plus shareholders' equity. And that's what we're trying to always see what we have. Because if there is a difference, if assets are greater than liabilities, then you can have shareholder equity, which means value to the shareholders. Whether you pay it in dividends or if you keep it within the company to fund further expansion, whatever it is, that's valuable. But there's a lot of companies where the liabilities are greater than the assets, and that represents where they have a negative shareholder equity, which means the shareholders owe money to the company, and they have absolutely no value in the company financially at that point in time when the balance sheet was written. But that could grow in the future, and that's why people invest with the hope that that can grow in the future. So that's assets and liabilities. The last part of this module we'll talk about is auditing. Auditing is the process where you take a look at your numbers. Now, through accounting, they'll tell you what the numbers are, and then you have to plug them into the various formulas, and you're going to have either an external auditor or an internal auditor examine the numbers to make sure they match. So if you say you had $100 million worth of sales, an auditor will determine whether or not you in fact had $100 million worth of sales. If you're a small company, you might have an internal audit, which will cost you a lot less money. If you are a large publicly traded company or a state entity, then you're probably going to have to do an outside auditor that will come in. They'll go through the entire books, they'll take a look at things, and then they'll come up with a letter at the very end. They'll basically say whether or not the numbers meet the generally accepted accounting principles, and if they have confidence that they could say that the numbers are correct. When the numbers aren't correct, they'll put a report out that will say, look, we have no faith or confidence in these numbers. We think there might be issues here, so we don't support it. You, of course, want to have that clean bill of health. That is what the federal government's looking for. That is what investors are looking for. That is what your company should be looking for, to make sure that there's no hidden traps where you might owe money you didn't know about, and all of a sudden the company has to go bankrupt because there are obligations that weren't on the books. Think of it like when you balance your checking account, and when you find out at a certain point that you have less money than you thought and you bounce 5 checks. That's what auditing is designed to do, prevent that from occurring. I hope you enjoyed Module 1. Thank you so much for listening. Have a great evening or rest of the day, whichever it might be, and I'll talk to you soon. Bye-bye.